Canada's economy saw no growth in November. And once again, somehow we're still technically not in a recession. But if this doesn't feel like a recession to you, you're not imagining that. Now, November GDP of last year, that's the most recent reading, came in flat, zero growth. But under the surface, Canada's splitting in two. Services are still growing, but goods producing industries are quietly contracting. And a lot of this is stuff that's related to housing. Manufacturing is down, wholesale trade is down, forestry and agriculture are down. Meanwhile, retail rebounded, education came back, transportation recovered from strikes, which is mostly your Canada Post. It's obviously not a sudden downturn, but it's a lagged housing slowdown that's working its way through the economy. And it explains why GDP can look fine, but why people feel broke and why 2026 almost depends entirely on housing and investment. Let's break it down. And as always, if you want macro explained through housing, not headlines, hit the subscribe button. Real GDP was unchanged in November after a 30 basis point decline in October. It sounds boring, but it isn't, because this could lead us towards the second quarter of declining GDP in 2025. But there's a bit of a split going on here. Goods producing industries are down about 30 basis points. Service producing industries are up about 10 basis points. Exactly half of Canada's industries actually grew. And so we're not seeing this economy-wide weakness that you would expect to see in a recession. And I've been the guy calling for a recession for far too long now, so I don't have a bias in saying that. But we are seeing a bit of a composition change, and where businesses are doing okay and where people are spending money is shifting around a little bit. So manufacturing really seems to be where the damage is concentrated. Manufacturing fell 1.3% in November. Durable goods were the problem. So your durable goods are like your stoves. There was a headline about furniture. I guess it would be a little bit less of a durable good. Durable manufacturing was down 1.9%. Transportation equipment was down 3.8%. Motor vehicles and parts down 6.4%. Durable goods manufacturing is now back to 2011 levels if you exclude COVID. This is cause for major concern. And it's also not random. Here's the key mistake that people make. They see manufacturing weakness and they say supply chains, semiconductors, I think during COVID, the ship getting stuck in the canal, global issues. These things matter, but this stuff is also very downstream from housing, right? Housing is a leading indicator, and housing already rolled over. The Globe and Mail recently highlighted something that lines up perfectly with this GDP data, and that's that furniture sales are slumping across Canada. And it's not because people hate couches. It's because the housing pipeline is dried up. Think about everything tied to housing activity. Fewer home sales, fewer new builds, fewer investors, fewer Airbnbs, fewer staged listings, no new homes, no flips, no short-term rental expansions. So the demand for durable goods related to housing collapses: furniture, appliances, cabinets, fixtures, building materials. And this is exactly what shows up in that GDP number. And this is how our overexposure to housing can drag the entire economy down. It just takes a while. We're like 2 years, 3 years past the peak and the drop in the housing market. It brings me back to Michael Cantrow's sort of cycle and how he sees movements move through the economy. First, it hits housing, right? This is this credit-focused product. People use debt to buy it. It's going to be immediately impacted by increases or decreases, but housing would slow. Then you would see residential investment pulled back. So that's your new orders. So people are ordering less stuff. Then profits of companies starts to decline. And then those companies have less money to hire people. So employment starts to contract. And we're just getting to that point where your unemployment is starting to ramp up and your mortgage arrears kind of start to follow it. And so this means, you see fewer manufacturing contracts, you see reduced wholesale trade. And that's exactly what we see. Durable manufacturing down, wholesale trade down 2.1%, motor vehicle wholesaling down 12.6%. When our condo towers and our entire housing pipeline starts to dry up, and this isn't everywhere, we are seeing a lot of rental construction in places outside of Ontario. But when you start to see that part of the economy contract, these are the knock-on effects that we're starting to see years later. And obviously your motor vehicle parts and accessories is getting hit really hard by the trade war. What is more interesting to me is whether or not housing is transmitting weakness into the real economy. Now let's sort of look at the bright side, let's call it. And I'm reluctant to say that because it's basically just government spending that's keeping the GDP propped up. So services are doing a lot of the heavy lifting in the economy. Retail rebounded by 1.3%. Education jumped after we saw a bunch of strikes end. Education up 1%, contributed most of the increase in the aggregate in November, partially offsetting October's contraction, largely driven by a rise in elementary and post-secondary schools as classes resumed in Alberta following the end of the teachers' strike on the 29th. Very similar story in the Postal Service. The Postal Service subsector jumped 41.7% in November after a 31.4% decline in October. Public spending, Postal Service, and two strikes ending, basically. These are the things keeping GDP from collapsing. But here's the problem, right? Services stabilize the economy, but they don't restart it. It's like a life support, right? And the government can continue to keep us on that by continuing to spend money, but it doesn't drive productivity. This doesn't drive investment, right? It's just the government spending more money. It keeps people employed. Those people have money, they spend their money or they save it or whatever. And it's just enough to make things feel not terrible. And that's sort of like the era that we're in of, like, a lot of people are asking, oh, the government's going to spend so much money. How do you not think inflation is going to come back? And it's like the government's going to spend so much money because the economy is getting crushed, right? Because it's getting crushed. And so they're trying to offset that deflation or disinflation. And this brings us to the GDP numbers everyone argues about. Now, Canada posted a positive GDP in Q3, but Stats Can attach this rare explicit disclaimer that the estimate was likely distorted by the US government shutdown, which disrupted cross-border trade and data collection and reporting. The translation is this number probably isn't accurate and may be revised, especially to the downside. They also telegraphed in their Q3 that they were expecting Q4 to be negative. Now, fast forward, November was flat. December's advanced estimate is 0.1% or up 10 basis points, and October was down about 30 basis points. So StatsCan is already signaling that Q4 GDP is likely negative. But this is where things get kind of like uncomfortable or annoying, or people start talking about like the government gaslighting them. And so in 2025, if we saw Q2 negative, but Q3 was a big jump up, so decreasing GDP in Q2, probably decreasing GDP in Q4. So in 2025, Canada likely will record 2 negative GDP quarters, but not consecutively. So once again, we avoid the technical definition of recession. No back-to-back quarters and no official call that might prompt policymakers of the Bank of Canada to respond to a recession. But economically, this absolutely feels like a recession. The technical definition of a recession is 2 consecutive quarters of negative GDP. But the lived reality that we're seeing right now is stagnant wages, falling GDP per capita on a per person basis. Our GDP per capita has been on a general downtrend for years for the most part, although GDP per capita likely avoided a decrease in Q4 according to National Bank, most of which is because our population is no longer growing. We're seeing weak business investment, frozen housing activity. Nobody's doing anything in the real estate market. Durable goods demand is collapsing. Canada has mastered this pattern, right? Economic stagnation without a recession headline. We've had many different tools that we've used to keep the economy propped up. First, it was population growth to keep GDP propped up and at the expense of GDP per capita. Now we're unwinding that, and I actually think that that's a really good thing. And I think that we can and probably should suffer through a little bit of GDP contraction. We need to sober up a little. And we need a little bit of economic Darwinism to take place. And it also is going to happen as a result of a lot of people leaving, which seemed to be the will of the public, and policymakers responded to that. So your GDP per capita might actually start growing if GDP can grow ever so slightly and just enough to outgrow the population. So when you pull this all together, housing slowed first, then you started to see durable goods following, manufacturing weakening, wholesale trade has now confirmed this. Services have been masking the damage, but a lot of that is because of public spending and big volatile returns to the economy in the education, which is public sector, and postal service, which is public sector. So these are sort of like statistical quirks that have made us scrape by on definitions in Canada. Our economy is not crashing, although it might actually be better for a lot of people if it did, because then the Bank of Canada and policymakers would be forced to pull out all the stops to help people. But you're kind of in this like long grinding adjustment down. And that is way more painful for most people. Like most people can handle a lot of pain quickly, like ripping the Band-Aid off. But it's like the bleeding out over time that a lot of people can't sustain because we're a debt-based economy. the longer that goes on, the more pressure each household is on to make their bills, make their debt payments, try and figure everything out. Time is the ultimate killer. And when I say time, I mean time without a recovery, right? And until housing and residential investment restart, manufacturing and productivity probably won't either in Canada. As much as I wish that things were different, our economy is just not exceptionally diversified. And so we still depend on this a lot. So Canada has been able to keep avoiding a technical recession, but the economy Canadians are living in has already felt like one for years. If this helped you understand what's actually happening in Canada's economy, please hit the subscribe button and drop a comment. Do you think in Q4 of 2025 is going to be positive or is going to be negative? Let me know what you think in the comments. As always, thank you for taking the time to watch this video. I try my best to read and respond to all of the comments. So let me know what you think, and I'll see you again as soon as I can.